Okay, this is Professor Hazara again, and this is the second of the three videos on the statement of cash flows. And I'm going to do it's one big example basically. I'm breaking into three parts. In the first part, I went through the three sections of the statement of cash flows. Keep in mind you have, and you should know this. This is all review: operations, investing, and financing. In operations, you start with your net income, adjust for current assets and liabilities, add back depreciation, take out gains, add back losses. Investing activities, you have two activities. There's the sales and purchase of long-term assets and flows from lending activities, loans you make to others. There's equal and opposite cash flows in each one. The proceeds from the sale of assets are the inflow for activity number one, sales of purchase of long-term assets, and obviously the opposite is you purchased cash paid to purchase assets. So you have inflow of sales from sales and outflows from purchases. And then for lending activities, the outflow is money you loan to others. These are all loans to others. Loans mean you're lending money, not borrowing it. Borrowing goes down beneath. And so for lending activities, the cash outflow is loan made to others. Loans made to others, the cash inflow is cash received from loans made to others when other people pay you back. Finally, in financing activities, you have two activities: issuing and buying back stock or paying back dividends, same thing, and cash flows from borrowing activities, or borrowing and repaying debt. Okay, the inflow for the first activity is you sell stock. The outflow from the activity is you buy back stock or pay dividends. For borrowing, the cash is received when you borrow from others, and when you pay back those borrowings, that's the cash outflow. Okay, so that's a basic format of the statement of cash flows. Now, I'm going to go over here to an example, and I'm going to split this example into two videos. In the first video, what I'm going to do is, this next video, is I'm going to go over some of the calculations that you have to make when you're doing a statement of cash flows. And for you CPA exam fans, I'll give you one or two hints on the CPA exam. Okay, and so let's start the problem. And then what I'm going to do in the second video is I'm actually just going to fill in the statement of cash flows here. Now, in real life or on the CPA exam, you wouldn't have the format given to you. You better know the format. That's why I talked to you about it in the previous video. But in this, to just cut back time, I'm going to keep short on time here. I'm going to go ahead and just do it like that. Okay, so whenever you do a let's go through the problem, and I'll go through. There's three calculations in this problem. I'm going to give you one or two golden rules. Okay, Sharon Feldman, this president of this company, considers $20,000 to be a minimum cash balance for operating purposes. As you can see from the statements below, only $15,000 was available for the end of 19X2, since the company reported a large net income for the year and also issued bonds sold from long-term investments. Declining cash is puzzling to Ms. Feldman. Additional information is below. I can tell you right now that all that information is basically nonsense. Okay, but here's the additional information. Now, in the additional information on the CPA exam, and even I'll tell you, even in real life when we do valuations, you're going to see, in a sense, that you're always going to get. You always look at any transactions having to do with plant and equipment first, because plant and equipment are the heart of a company. Plant and equipment are its investments. This is traditional companies anyway. Now it's more R&D, but let's stick with plant and equipment. Plant and equipment is the biggest asset of any company. It's the asset that produces a company's revenue. Just think of a traditional manufacturer. And by the way, in this country, we still do a lot of manufacturing. Okay, so always look. We're going to analyze the plant and equipment account first. And the reason that we're going to analyze the plant and equipment account is that from this analysis of these two T accounts for plant and equipment, we're going to be able to pull out several items that go on to the statement of cash flows. We're going to be able to pull out the cash that comes in from the sales. That's in the investing section. We're going to be able to pull out the cash that goes out from the purchases of property, plant, and equipment. That's also in the investing section. Okay, then we're also going to be able to isolate any loss on the sale of plant and equipment, and we're also going to, or gain if we had a gain, and we're also going to be able to calculate a depreciation expense. And usually you do this on the CPA exam in real life by, in one way or another, working backwards through the plant and equipment account and figuring out all these things: the sales, purchases, depreciation expense, and any gains and losses. Okay, now in this problem, here's one of the golden rules. You'll notice you got additional information on plant and equipment, and you will always have it. You always have it, or else you don't have a company without plant and equipment. Okay, so that's always the case. The other thing I'm going to give you is that the big CPA hint is for any account for which you're given additional information. In this case, they give you additional information on plant and equipment. They always do. But for any account on which you're given additional information, always analyze the T accounts. Any balance sheet account. For any balance sheet account which you're given additional information, always analyze those accounts. Okay, and so that's why it says here in A, company sold long-term investments. That's why I'm analyzing the investment account here. This is the long-term investment account I'm analyzing down here. And finally, you should always analyze retained earnings just to confirm the net income and convert the dividends. That you should remember somewhere along the line from your accounting courses. Okay, so anyway, so the big hint is, number one, you're always going to get information on plant and equipment. You always have to do this first step. Analyze plant and equipment to get the depreciation, this cash coming in from sales, cash you pay for purchases, any gains and losses that you got to put in the operations section statement cash flows. Then look for any other long-term balance sheet items. And I say long-term because you know that all the current items go in operations anyway. So look for anything, any long-term item, including long-term investments, maybe bonds payable, and analyze those T accounts. And the reason, I'll show you the reason in a second. All this problem isn't necessarily good for the reason. Okay, so let's start here by analyzing the plant and equipment T accounts. And I'm going to focus in on this section right here, that right there. I'm going to focus in on the plant and equipment, the beginning balance, the ending balance for plant and equipment, and the beginning balance and the ending balance for accumulated depreciation. Okay, so here's what I'm going to do is I'm going to enter the beginning balance for plant and equipment. So the beginning balance for plant and equipment is $750. The ending balance for plant and equipment is $860. Yep. Okay, good. And then I'm going to put in the beginning and ending balances for accumulated depreciation. Beginning balance for accumulated depreciation. By the way, I'm going to put a negative there. Remember, you can't have negatives and positives in T accounts. The side of the T account is a negative or positive. Okay, then I'm going to put in the ending balance for accumulated depreciation, which is $210. Okay, so what I'm going to do now is I'm going to recreate the three entries, the only three entries that ever take place in the plant and equipment and accumulated depreciation accounts. One entry is the sale of plant and equipment. Then you're going to have purchases of plant and equipment. So either you sell the stuff or you buy the stuff, or the third entry is you depreciate the stuff. So what they always give you on the CPA exam, they will always give you in any problem, and in real life, you'll see that it's the heart of valuation, in a sense, is they always give you the information on the sales of plant and equipment. So they give you this journal entry. And then what you have to do is, after you get this journal entry, you have to back out the second two journal entries from the T accounts. So let's go ahead and start this. I'll show you how it's done. Okay, if you read this, the entry B here, it says, equipment that had cost $90,000 and on which there was accumulated depreciation of $40,000 was sold during the year for $44,000. So here's what they're telling you. They're telling you, number one, the equipment was sold for $44,000. Okay. You sold it and it had accumulated depreciation of $40,000, so you have to write off the accumulated depreciation for $40,000. Okay, and then the only other thing it tells you is that it had a cost of $90,000, so you've got to take $90,000 off the books. Okay, so remember that the net book value is the 90 minus the 40, so the net book value is 50. So what's happening is if you take the 90 less the accumulated depreciation of 40, net book value of 50, you're selling something worth 50 for 44,000, which means that the plug entry here, and it is a plug entry, is a loss of 6,000. It's a loss of 6,000. Okay, so I'm going to go ahead. I guess I'll put that in red for lack of any better thing. But that loss is going to go on the statement of cash flows. And this cash here is going to go on the statement of cash flows. Now, if you recall, I'll just move a little bit ahead here. The cash that comes in from the sale of long-term assets is going to go, I'm moving a little bit ahead here into the next video, but I might as well say it. It's going to go here. Sale of equipment. You're going to put it there. And where does the loss go? The loss always goes, losses and gains are always netted out in the operations section of the statement of cash flows. I'm going to ask you in class why, because I want you to have a solid understanding of this. Also keep in mind that you've got two balance sheets here. Here are your balance sheets. Here's going to be your balance sheets. In the next video, we'll get more into these balance sheets. Here's your balance sheets. And then you've got your income statement right here. Got your income statement. So $70,000 net income. The reason I'm pointing that out is that that loss of 6,000, that loss of 6,000 is the same as that loss of 6,000 there. So it could be in the footnotes of the income statement. I decided to put them, disclose them on the face so that you would see that there's a loss on the income statement that actually you're going to offset by adding it back. Okay, so let's go ahead and post this entry now. It's entry number 1. I call it entry number 1. And let's post this entry to the 2 T accounts. Now, those 2 T accounts, the only thing is, the only 2 entries that are made from entry number 1 is number 1, there's a credit to the plant and equipment account. Okay, so I'm just going to go, this is equal to 90,000 here. And there is a debit to accumulated depreciation because you wrote off $40,000 in accumulated depreciation. So I've got those 2 right there. Now, the other 2 you don't have to worry about with respect to those accounts because one's cash and the other one's loss. So they end up in other T accounts. Okay, so now if you recall here, and what I'm going to do here is I'm actually going to put question marks. I'm going to put a question mark here. I'm going to put a question mark here. And I'm going to put question marks here and here. And the reason I'm going to put question marks there is because everything up to now has been given. I have given you the beginning balance of, that right there. You got the beginning balance of plant and equipment. You were given it to you got it from the balance sheet. You were given the ending balance in plant and equipment. You were given the beginning balance in accumulated depreciation. You were given the ending balance in accumulated depreciation. And by the way, you were also given in part B here, you were also given this entire journal entry. So everything up to now has been given. So the point is, there's what I call the 3/4 rule. And I call the analysis, this type of analysis, the 3/4 rule, because what you've got to do now, and there's a lot of CPA exam problems like this in many different topics, is if T accounts always have 4 parts: beginning and ending balances, and debit and credit. If you can figure out, if you have 3 of those parts, you should be able to figure out the 4th part. Okay, so, and the debit here in entry 2 is going to be this debit right here. It's going to equal that debit right there. So if you can figure out from this T account here, you can figure out that debit right there, you will know how much cash they paid, and you will know how much to plug in to that journal entry right there. So let's figure out that amount right there, and that will equal that amount right there. I actually have the calculation right there. Okay, so you just have to ask yourself how much, and you can play a little bit of trial and error here, but you have to ask yourself how much would you have to put into that debit right there where that cursor and question mark are. How much you have to put in there, I'm hoping you can see the cursor there, how much you have to put in there in order to get that account to balance. The easiest way is just, in this case, take the balance, take the ending balance, let's see what you got here, yep, take the difference between the beginning and ending balances, which is 110, and add the credit here, and that gives you 200,000. Now, that's sort of an educated guess, but just ask yourself, does it account balance? If you take 750 plus 200 minus 90, that does give you 860. So that credit there is 200,000. And as it turns out, that debit there is for 200,000. That's the only number that gets that account to balance. So that debit there should be equal to the amount of this journal entry here. And so that gives you the amount of cash that you paid for plant equipment. And that's going to go, this credit to cash here is going to go into the investing section of the statement of cash flows as an outflow. So I'm going to just put this here and put question marks here. That's one of the accounts I solved. Now the other one account you have to solve is your credit to accumulated depreciation. And remember from accounting 001 that your depreciation expense entry is always debit depreciation expense and credit accumulated depreciation. So if you can figure out this credit here from this account here, and once again, if you have three parts of an account, you should be able to figure out the depreciation. If you can figure that out, then you should be able to calculate, know the number that you put into your depreciation expense. One way to do it is take the difference between the balances. The balance went up by 20. Add the opposite, and it gives you 60. So ask yourself, is 190 plus 60 minus 40 equal to 210? Well, it looks like it is, because 190 plus 260 gives you 250, minus 40 gives you 210. Okay, so we know from this amount here, I'm just going to put question marks, meaning that that's the number that I had to figure out. Okay, so if you know that credit, you know this credit here, that's equal to that credit there, and this is equal to that credit there right there. So you know your depreciation expense. So I'm just going to go ahead and put that right there. When we continue the third video, I'm just going to take those numbers and throw them right into the statement of cash flows. I've got the loss on plant equipment. I've got the cash that came in, the cash went out, and I've also got my depreciation expense. Okay. Next, let's go down to the summary of the investment account. And the reason I'm analyzing the investment account is because they mentioned it up here. If they don't mention it up here, you do not have to look at it, but they did mention it here. And the reason that they like to put items there is because they like to see if you can analyze, if you can find items that they don't tell you about, and they're hidden on the other side of the account. Okay, in this case, it doesn't turn out, there's no item hidden anyway, so it doesn't matter. But I'll just show you how you do this. Same logic. Okay, so I'm going to start with the long-term investment account. It's this account right here, just right near the top here. Your beginning balance is 120. Your ending balance was 90. And then like the plant equipment, they'll always give you the sale entry. Notice that they gave you the sale entry in item B here for plant equipment, and they also gave you the sale entry for long-term investments. For assets, they usually give you the sale entry. Okay, they almost have to. Okay, so the only thing we have to figure out is we have to figure out if they sold any. They tell you that they sold any, and I'm going to figure out the sale entry right here and put it in. But the reason I'm doing this, and as it turns out, this problem, which came sort of a CPA adapted medium difficulty level CPA problem, is the reason you do this is to make sure that they didn't sneak a purchase in on the other side. Sometimes they do, sometimes they don't. But if they give you anything in the additional information, take a look at it. Okay, so what does it say in the additional information? In the additional information, it says the company sold long-term investments with an original cost of $30,000 for $50,000. So here's the entry. They sold it for 50. The cost was 30. Okay, so there's $50,000 of cash that came in. $50,000 of cash that came in, and that's going to go. I'm going to put this in heavy red here too, because that's going to go into the investing section of the statement of cash flows. Let me try that again. That's going to go into the investing section of the statement of cash flows, and they said that it was $30,000 was the cost. They gave you that amount right there. So they must have had a gain from that information. Know that they had a gain equal to 50 minus the 30. So they give you the 20 right there. Okay, and this gain is going to go onto the statement of cash flows. The two things that are going to go on the statement of cash flows from this transaction are the cash that came in goes into the investing section as a sale of long-term asset, and the gain is going to be subtracted out in the operations section of the statement of cash flows. Now, let's ask ourselves, this is the sale. Were there any purchases? And this is why you always look at when they have additional information. They try to sneak information there. Were there any purchases? Well, it looks like, and by the way, I have to make sure I post my entry here. Right there. And so I have to ask myself, does this account balance, given the information I've had, and given that I've got 3 parts, 4-part account? It looks like it does. 120 minus 30 gives you 90, so purchases were 0. Now, the reason I'm going through this, and even though I've already put it down here that purchases are 0, sometimes the account won't balance. And if the account doesn't balance, you better find out how much the purchase was. And in the problem I give you for the take-home, just a little take-home problem. I'll try to trick you a couple on that one. Okay, and so the purchases, the long-term investments were 0. If you did have something there, purchases, they'd go into the investing section. Okay, finally, you should always, always, always summarize the retained earnings account just to make sure that your net income minus your dividends equal your ending retained earnings. And it's also a way to figure out your dividends. So your beginning retained earnings are 150. Your ending retained earnings are 787. Your net income better come from your income statement. Your net income is equal to 70,000. Okay, and so let's figure this out. If you went from just a minute here, your ending retained earnings, are 192. I missed a line. I'm notorious for that. So if your retained earnings went up from 150 to 70 and ended up at 192, one way to do this, figure this out, I believe, would be to take the 150 plus the 170 minus the 192. That gives you 28,000 in dividends. Okay, so obviously dividends is going to go into the financing section of the statement of cash flows, but it's always good to reconcile your dividends. And by the way, let's see up here. Let's see, and I didn't tell you this on purpose. I use this problem for the MBA class too, but I didn't show them all the T account stuff, so I'm upping the difficulty a little bit, and I could do it a lot, but we're going to keep going here in class. But notice depreciation is 60. Okay, so the depreciation here, we figured out there's 60. That was given. $200,000 of equipment was purchased. There it is right there. And then cash dividends of $28,000 were declared and paid. And those are your cash dividends. And I will put those dividends right here in red also, because your dividends are going to be very important. Okay, so those are preliminary calculations. Always analyze your property, plant, equipment account, and they will always give you the sale information. So always put those up, post the balances and the sale information here, and then back out the purchases and the depreciation expense. Also look at any other balance sheet accounts, and they're going to be any long-term balance sheet account, long-term assets, bonds payable, whatever, to make sure that, analyze the account to make sure that there's not something on the other side of the account that they're hiding and not telling you about. And then finally, always look at your retained earnings. Okay, I'll put this video up. This is the number 2 in the series. Thank you very much.